Right. Hello, everyone. Good afternoon to those who are joining us from the United Arab Emirates, from Saudi Arabia and Pakistan. Good morning to those who are joining us from Egypt, United Kingdom, Nigeria, Burundi, South Africa, Tunisia, and Morocco. I also would like to give a special morning for those who are joining us from the US and Canada. And I really hope you guys joining from the East Coast, so it's not insanely early at your time right now. Thank you all for your time to attend this interesting session that is going to be delivered by a very diverse group of people. On the panel today, we have private equity investor, a leading lawyer, an underwriter, a broker and advisor. We also have an in-house counsel. All of this to discuss the investment environment and some of the practical solutions in the mergers and acquisitions in the Middle East. I promise you, you'll hear very interesting thoughts from different angles, so please stay with us. The Middle East has seen significant spike of investments last year. The Middle East recorded a strong M&A activities with more than 660 deals in financial years 2021. This represents 51% increase from the 2020's figure, with a total value of $89.9 billion worth of investment. Also, the region has seen more than 70% increase to the total use of the warranty and indemnity policy in 2021, which is the subject matter of today's webinar. And actually, all of this has led us thinking, it's not really a bad idea to bring some people who can talk about this matter and really tell us what's going on. So without further ado, let me please introduce you to your panelists today, who I promise not just only a bunch of pretty faces. I promise you, we have so much more to offer today. Lastly, if you have any questions for me throughout the session, please send them to me directly. I'll be receiving those. You can direct your questions to a certain speaker, or you could just ask me the question and I'll find who's the suitable speaker to answer them. So, on the panel today, let me start with Nirav Modi, who is the private equity and M&A leader at Marsh. Nirav has more than 15 years of experience within Marsh. He has built up an extensive track record in all of private equity and M&A's businesses across MENA for financial sponsors and strategic clients. Nirav has worked over 200 transactions covering risk insurance due diligence, transactional risk, including warranty and indemnity insurance, structured finance, political risk insurance, as well as managing portfolio programs for private equity funds and international lenders. We also have on the panel today, Marsh Khodeir, someone I work very closely with. Mohammed is the founding and managing partner of Khodeir Partners. Mohammed is a renowned legal figure in the Middle East. He holds a track record over 22 years advising investors doing business in 4 jurisdictions in the Middle East, which is going to be very actually useful for us today covering the Middle East region. Mohammed total deal sheets has exceeded $50 billion in terms of value in his old transactions. Before founding Khodeir Partners, Mohammed was the former CEO of the General Authority for Investment and Free Zone in Egypt, which we refer to as GAFI. During his time serving public office, Mohammed has led the project of issuing the new investment law of Egypt, which is again going to have a lot of insight for us today in terms of the environment of investment in Egypt. Before all of that, Mohammed was a partner at Tanimi & Co. He managed 2 of the major offices in the Middle East. He also has been consecutively recognized by legal rating agencies as one of the leading lawyers in the region. Next on the panel, we have Stanley Hearst, who is a senior underwriter at Liberty Global Transaction Solution. Stanley joined Liberty Global in London in 2020. That must have been a very interesting and challenging time for you, Sally, to join, I'm sure. She has a particular focus in deals in the UK and the EMEA region. Sally has underwritten a variety of transactions across EMEA region in a diverse range of sectors, including healthcare, pharmaceuticals, tech, infrastructure, businesses. Not only that, before she's doing what she's doing at the moment with Liberty Global, Sally was a corporate senior associate at the London-based law firm Trevor Smith. When she used to practice law, Sally specialized in international private equity transactions and M&A. She also worked across multiple jurisdictions and sectors, advising institutional investors corporates and management on their corporate transactions. Looking at the private equity side, we have today Zahid Kamal, who is the managing director for Fajr Capital. Zahid is actively involved in various aspects of Fajr Capital's investment and strategic initiatives. He is also a board member and a committee member of CRAV Group, GEMS Education, and National Petroleum Services. Zahid is also a member of the Global Private Capital Association Council in the Middle East. Before all of that, Zahid was also a senior corporate lawyer at the international law firm Ashurst, both in Dubai and London. He has substantive experience, including advising public company on transactions, private equity, M&A, public takeovers, IPOs, investments, fund, secondary offerings, restructuring, and joint ventures. That's for Zahid. Finally, from a client perspective, I am very delighted to say that we have Dua Kandil today, who is the head of the legal team at Kraft & Heinz in Egypt. And actually, I would like to call Dua the guru of the FCMG, and I'm going to tell you why in a minute. Before joining Heinz, Dua did work as in-house counsel in Cadbury, PepsiCo, and Mondelez. Dua has more than 20 years of experience as in-house experienced lawyer. She has seen more than just FCMG. She worked in-house counsel in several sectors like management consultancy, microfinance, and cement industry. Finally, Dua has seen enormous number of corporate projects, including mergers, acquisitions, integrations, and general corporate transaction. I think all of that will be very helpful for us today to kind of touch upon. So thanks, Dua, for joining. Finally, that's me, your moderator for today. My name is Ammar Al-Banna. I am the founder of Incept Legal in the UAE, and I'm also an off-counsel at Khodeir Partners. I have 15 years of experience in private practice. I've advised several number of clients in different jurisdictions, namely UAE, Bahrain, and Egypt. I was fortunate enough to get involved in several and various sectors, including oil and gas, pharmaceutical, education, banking and finance, management, consultancy, maritime, real estate, and FCMG. It's actually quite funny hearing myself talking about myself in this manner, but anyway, I'll proceed. I was also a lead lawyer in a number of groundbreaking cases that I'm very proud of, resulted handing in new legal precedents in the UAE legal system. I am also a legal trainer with the Dubai Legal Affairs Department, and I have authored a several number of legal articles in the UAE and Egypt. So here we are. Without further ado, I would like to start the discussion and jump onto the juicy stuff. And maybe I'll start the question by addressing the discussion toward Mohammed. Mohammed, given your experience in the Middle East, not only Egypt, I would like to know from you, and before talking about W&I and warranty and indemnity policies, I would like to hear your views on the mergers and acquisitions market in general and the investment environment, both in the Middle East and Egypt.
Thank you, Ammar. I'm very honored to be on joining such a distinguished panel and such a very important topic that we are discussing today. And I think just going on to the macro side of things, I think we were talking, a friend of mine, just very soon during a visit to Dubai, and we were saying that the new normal now is to always have something not normal happening around us. I think the whole world has started to learn that there will always be something like COVID, something like the war in Ukraine. These are very challenging crises, and people and all firms and organizations are learning how to deal with this new normal with business as usual. So if you look at the numbers you mentioned last year, these are not numbers that indicate that there is a stoppage of activity in terms of M&A, in terms of investment influx and so forth. But obviously, no one can deny the gravity and the grave impacts of this crisis that is happening. I think many commentators see this as something similar and deeper than the Great Depression. The economics of the whole world are impacted. The supply chains are impacted. So this puts pressure on everyone to be very creative in the models that they're using in any type of business. talking about investment, to answer your question, I think we're very fortunate to be part of this region, because I think the GCC states are one of the few jurisdictions that the impact of this crisis is not as negative as the rest of the world, given the oil-focused economies. And the other aspect is the reforms that have been happening in this region have been tremendous in the past few years. In the UAE, the legal system has been revived and has diversity that includes adapting international practices in the DIFC and ADGM. You have other jurisdictions that are reviving the whole cultural and legal system as well, like Saudi Arabia. Egypt is no foreigner to all that. Egypt has been undertaking a very aggressive reform program since 2014, has been escalating at all levels of the economy and investment in the infrastructure to facilitate opportunities for investment. The government has been heavily involved in this investment period, but now has recently announced a full exit plan from all the investments that have happened on the private level or perceived as private sector potential investments, and not on the strategic ones. And this exit plan includes up to $40 billion of assets in the next few years, as well as M&A opportunities and IPO opportunities that are related to entities owned by the government. So with this exit plan, there is a huge interest in the activities of acquisitions in general, whether assets or companies, and at the government level. And by default, that stems a lot of activity at the private sector level and consolidation activity between companies in distress. So I think the M&A activity in the next couple of years, subject to not having a different new normal that changes all the dynamics, will be very, very active, and there will be opportunities to bring about a lot of creative solutions like the one we're addressing today.
Thanks, Mohammed. Actually, this makes perfect sense. As everyone have seen recently the news, the Crown Prince of Saudi Arabia have just visited Egypt a couple of days ago, and they signed more than 14 agreements of investment and infrastructure in Egypt worth of $7.7 billion. So, there's a lot to come and see. I've personally met investors coming to Egypt wanting to buy a number of small companies in Egypt. So I think I echo you, Mohammed. There's a lot of opportunities happening, I think, in the next years. I would like to look at you, and given your expertise as an in-house counsel in Egypt for more than 20 years, you've seen many M&As during your tenure as in-house. What I would like to ask you, coming somewhat out of the pandemic, the M&A activities in Egypt, as Mohammed said, seems to be on the rise. Is this the beginning of the market in Egypt to open up?
Okay, so it's funny that you ask, thank you first, Ammar. It's funny that you ask the question that way. The pandemic was not the first crisis we saw in this region. I believe that our crises started back in 2011 with the start of the Arab Spring. I think that was the dip we saw in the M&A activity in Egypt and the region. Before that, Egypt was an investment hub. In my role as a head of legal and lawyer in several of the FMCGs I worked in, most of these companies were actually family-owned businesses that were purchased and acquired by multinationals. So this was back in the 1990s and the early 2000s. Coming back to your question, yes, I think we are on the up and up in terms of M&As. Egypt has always been a very appealing country for investment. Possibly this is related to the way the economy still is until today, because I worked in the financial industry for some time. Until today, the economy of Egypt is still majorly comprised of family-owned businesses, which still makes it very appealing. Going back to the government reforms that are taking place and all of the government focus to help investors, new investors and the existing ones. To what Mohammed was saying, that reforms are happening on the GCC level. We see units being established, helping out under the supervision of the ministries, helping out current investors, new investors with their challenges and bottlenecks with the government. So yes, I think we are on the up and up, and I think there's more to come with that.
Thanks, Dua. That's very promising indeed. Nirav, I would like to start talking about the topic of today's session. I think that's the main reason everyone has joined us today. If we can steer the discussion toward warranty and indemnity, I'd like to ask you just an open question, just for everyone to understand. What is a warranty and indemnity insurance policy to start with? What does it do? What kind of problems do these policies solve to start with?
Thanks, Omar. And I think, whilst I say this, and I'm picking up from what Mohammed and Dua also mentioned, the region is changing. The region has changed pretty significantly since the time I've been here. And that's not a long period of time. In the last 5-6 years, I've seen the region change dramatically. Now, obviously, change also brings in uncertainty. Change also brings in opportunities. And then there are inherent risks to how you deal with these opportunities and risks. And hence, we're talking about warranty and indemnity insurance as a solution to sort of, understand where it can help mitigate, risks to an underlying transaction. Now, this is where warranty and indemnity as a solution backstops a financial loss effectively, as a breach of a seller's representations and warranties that a seller would typically provide under a sale purchase agreement that is being entered into between the buyers and the sellers. The solution is pretty much a mirror of how the reps and warranties are being stated under the SPA or the sale purchase agreement. It's a long-term solution. So basically what it means is that different warranties, be it business warranties or fundamental warranties, tax covenants, etc., for the time period and for the values that they are sort of represented against under the SPA, the policy tends to mirror that, right? The policy or the solution is meant for covering unknown risks. It is not meant to cover or not meant to provide protection for known risks. So anything when there is a transaction taking place, due diligence advisors coming in from the buyer's perspective, do their due diligence, they don't tend to pick up something or something is sort of missed, or sellers very smartly, many instances, and there are obviously cases and examples and experience of it, where sellers collude at times with their sort of advisors, sort of trying to botch up their financial statements or books of accounts, etc., to gain higher valuations. All of them are smartly sort of packaged in, which at times, the buyer's advisors don't pick up. All of that subsequently post-transaction close can result into a liability onto the incoming buyer or the incoming investor, which is where in the event of such a breach or in the event of such a liability coming to the fore, warranty and indemnity insurance as a solution can pick up those sorts of liabilities that have now come on the head of the buyers, provide them protection against that. Now, with respect to problems, obviously, I would rather say that there are advantages to how one should be looking at this particular solution. The solution has both buyer side advantages as well as seller side advantages. Now, pretty much from a buyer's perspective, it provides, recourse to the insurance company directly as compared to, providing a recourse or buyers trying to litigate against the sellers for any potential breaches or liabilities that might emanate. Again, a lot of transactions that we've seen in the last few years have been bids or auctions in this part of the world. So the buyers can use warranty and indemnity solution as a way to differentiate their bids when they're bidding for a particular acquisition or an asset sale. They also tend to get a significant advantage when buyers are trying to purchase a stake into a company, but the sellers or the management of the sellers are still rolling over. So you don't want to get into bed with somebody who who's going to continue with you, and you don't want to sue them subsequently, right? So these are some of the advantages from a buyer's perspective. I think from a seller's perspective, I think the biggest advantage that they have is achieving a clean exit, which is predominantly how historically people have tended to see warranty and indemnity insurance as a solution, because it was meant pretty much for private equity guys, right? Where they have a limited life cycle, they would wind up after a certain number of years, but they want a clean exit. They don't want to be on the hook for any liabilities that the buyers might bring onto them, right? So pretty much clean exit is something that the sellers have a big advantage in using W&I insurance for. Again, if there are sort of, it allows to sort of club in or breach the gap between what the buyers are expecting as a sellers to provide as indemnity caps or escrows, for example, and the sellers are not sort of willing to provide to a certain degree that the buyer's expectation is. That's where warranty and indemnity insurance can pretty much come in and help bridge those gaps as well and meet those expectation mismatches. Yep.
Thanks, Nirav. And I can't help myself not noticing Zahid got very excited when he talked about exits and IPOs. So Zahid, no worries, I'll come to you in a minute. But before that, actually, I'd like to speak to Sally. So Sally, Nirav have given us a very useful overview. There are some benefits for sellers. There are some benefits for buyers. Very interesting policy, I have to say. I personally had a discussion with several clients. Despite not being a corporate lawyer, a number of them has expressed their frustrations into how sometimes a W&A can actually salvage a transaction from just being stopped. What I would like to do with you is to dive in a little bit, to zoom in a little bit. As far as I understand it, one of the key benefits and advantages of W&I policies is that the insurance cap on liability is often greater than the liability we normally see in a typical sale and purchase agreement. To that extent, are there any other enhancement that W&I policy can provide to the insured to broaden the scope of recovery under the policy versus the position under a typical sale and purchase agreement?
Thanks, Moore. Yeah, and I think this is one of the kind of really interesting points of a W&I policy and why it can be very beneficial to a buyer, particularly in an auction process. Because what we can offer is additional enhancements, as you say, which can broaden the purchaser's scope of recovery without having to broaden the seller's liability. So that can put you in a really advantageous position in an auction process. So along with the higher liability cap, another kind of enhancement that could be offered for a small premium is extending the warranty claim periods. So for example, under your share purchase agreement, you may have a 2-year claim period for general warranty claims and 4 years for tax claims. So under the W&I policy, that can be extended to 3 years, for example, for general and 7 years for tax claims. Another enhancement, which is one that's very popular, is what we call a knowledge scrape. So under a share purchase agreement, often the sellers will be only willing to give the representations and warranties on a knowledge qualified basis, i.e. so far as they're aware, the business has all the licenses in place that are required to operate. What that leaves the buyer with is a scenario where they can only bring a warranty claim if the sellers were aware of a license being missing and they didn't disclose it. What we can offer under the policy is to disapply that knowledge qualifier. So this essentially is a really kind of beneficial enhancement because it broadens the scope for recovery. So it becomes irrelevant as to whether the sellers were aware or not. If the license isn't in place, then there is a warranty claim under the policy that the purchaser could bring. And a third and final enhancement, of which there's many, but these are the key ones that we often see, is what we call a synthetic tax covenant or tax indemnity. So often sellers will be unwilling to provide a tax indemnity in respect of the target that they're selling. And provided the DD is carried out, what we can offer under a W&I policy is what we call a synthetic tax indemnity. So the buyer can get the tax coverage without having to ask for it from a seller, and that can be just done purely under the policy without having to involve the sellers in the process at all. So those are the key ones that we use. There's plenty of others, and they are used depending on the transaction dynamics, but those are the key ones.
Thanks, Sally. I think it's very useful, to be honest with all you said, and I think I can read some of the people's attending with us today mind that saying, okay, we have Marsh Insurance, we have Global Liberty Global, they must be selling their policies. But that's why we have here Zahid with us today to kind of give us his views on a practical point of view. So Zahid, having been through both investing as well as portfolio investment and having used WNI on both fronts, I would like to hear your views generally and your clients' feedback as well, if you'd like, on the WNI. What do you think of all of it? How did it go for you?
Sure. Thank you, Amar. And yes, we do like exits, very much so, more so than investments. But yeah, I think the first time I came across WNI was 2003. At that time, I was in private practice, and we did use it for an acquisition. But my memory of that is that it was almost like a scam. Sorry, Marsh, sorry, Liberty. But at that time, it was a useless product. It was, in the end, after a sort of month of work, the ultimate conclusion we reached internally is that it's a box ticking exercise. Somebody needed it to tick a box internally at the client level, because the product itself really wasn't developed. It was pretty circular in the way it worked. So as a result, we never looked at it for about 10 years. And coincidentally, about exactly 10 years later in 2013, in the market, we were very aggressively looking for assets. And what we found is that there are a lot of assets in existing PE portfolios that were just ripe for exits. But one issue, of course, as most of you know, is that private equity, like us, they don't give warranty cover. So at that time, we started doing a little bit of research around how do we get comfortable with that, because we wouldn't be able to acquire something without having some kind of coverage. So that's when we came across Marsh. And at that same time, we found an asset owned by Ashmore in Saudi. Unfortunately, the first time we used at Fajr Capital warranty indemnity insurance was in one of the toughest markets to actually use warranty indemnity insurance. It was in Saudi, but it took some time. It was the first ever WNI insurance policy into Saudi, but Marsh did a good job of sort of hand-holding and getting it through. The process, I'm sure Marsh, Nirav will discuss later in terms of the different jurisdictions having different challenges in terms of how you got to structure into it. But as a product, it was just right. So by the time I came back around 10 years later, the product had developed quite a bit. It had substance. There were already some assurances around claims, not in our market, not in the MENA region, but in other markets, sort of Europe, US. So that gave us some confidence to actually use it on an acquisition where we needed it to work. And Ashmore, and in terms of the split of, I mean, one of the things that's always discussed is who pays for it. I don't know if you're covering it later in this conversation, but in our case, we kind of negotiated a 50-50 split. And you price it in. I mean, you think about it from the beginning and you price it into your bid. So the process, I mean, it started off as a bilateral, went into auction, this particular asset, and then went back into bilateral with us, along with our partner in Saudi. So that was the first time we used it. Since then, we've considered it pretty much for every transaction on the way in. But then when our sort of funds went into sort of the exit cycle, one of the things we did is, having learned from using it on the way in, we started also having a lot more interactions with people like Marsh to understand the product's progress. So we would almost annually get an update visit from Marsh and the Rav and his team to update us on what's going on with this product, having used it on the buy side. So what we started to do is, when we were looking at exiting some of our assets, we were grooming these assets from day one as usual, but sort of about a year and a half in advance of a potential exit, we started grooming the companies much more significantly in terms of capital structure, governance as well, but also vendor due diligence. So legal, tax, etc. We started getting data rooms together. And exactly at the same time, we were looking at potential stapled financing. And WNI formed a part of another stapled item offering to potential buyers. And at that time, we start any exit process, structure any exit process as either an IPO or an auction. In IPO, it's a different insurance product. We've worked on 2 different IPOs for our exits, but on the private track side, we look at it as part of vendor due diligence. Start very early, engage people like sort of Marsh and the insurers, so that right from the outset, we can go to potential bidders and say, here's the legal due diligence, tax, financial, but here's also the product that will give you the insurance cover. We don't say we're going to pay for it. We say that the buyer will pay for it. But in the end, we always get to a mutually agreed place. It all depends on the price. If somebody pays us more, then obviously we'll pay for it. In the round, it doesn't seem to make much difference to the buyer or the seller, the premium, oddly enough. Although it is important because it's in the context of a transaction. So long as the price is right, nobody minds. So I think we have started to, so that's exactly how we evolved into using it in our exits. What's also happened since then is that we are seeing opportunities. So one of our assets we sold to a sovereign. So first of all, we're not giving warranties to them, but they needed coverage. So we started the process on our side. It was a sell side policy, which switched to a buy side. The other things we also find nowadays is that some of these sovereigns right now, we're looking at an asset which is currently owned by a sovereign, and we're never going to sue a sovereign or a government-linked entity. No,
we don't.
no, we don't. And then also there will be amazing credit. You don't really. So in the past, we've looked at warranty indemnity insurance to get cover where somebody's not giving you the cover, and also somebody whose credit quality or proximity for us to hold on to is not going to be there. They might leave the region. But when you have a sovereign on the other side, they will give you warranty cover and they have good credit, but we don't want to sue. So in that situation, very likely we are going to go with warranty indemnity. So I think what we're seeing is the utilization and the uses, the multiple uses. Niran mentioned founders. Whenever we bought from founders, any of our assets like GEMS Education, we didn't take warranty indemnity insurance because the founder was remaining with a large stake in the business. So we didn't have a credit issue. They gave the warranties. But looking back, if we had to sue that individual, things would have got very messy for the remaining sort of 5-6 years of your relationship. So I think going forward, we're going to be looking at it very differently. And we're going to use these products very strategically as well. And then overall, I would just say it just makes the transaction process a lot smoother. You are not negotiating liability caps, etc., for days on end with a counterparty. Yes, the insurers expect a level of negotiations, but it's very different from when you don't have W&I insurance. And I think one piece that is missing, and Sally mentioned some of the enhancements, and she referred to tax. In our region, we haven't got tax coverage yet. So we would like to see that from Liberty and others.
Good. Thanks, Zahab. That was really actually very well articulated, I have to say, and I can see the benefit of you becoming who you are now, and your background as a lawyer. I can see how this can help structuring your idea, and I really like the way you contemplated it. So thanks for that. Dua, maybe I'm sure you also have something to share based on your experience. Just commenting on what Zahid has said from a client perspective. Have there any situation that you would have hoped for W&I to be involved in any of the merger and acquisition that you have seen? Anything you would like to elaborate on that point?
When we first started speaking about the W&I and I came into this group and we started discussing it, I actually found it very interesting. It's a great insurance policy. It's very well from a seller's side, and that's the side that I was on. In my experience, there was an acquisition. The acquisition was taking place. We had a tax issue, exposure matter, and once that came into play, the discussion between the buyer and the seller completely turned around. And it was either a no-go on the whole deal, or because of the tax exposure, they would take a discount. They would give them a discount on the price, about a 15-20% discount on the price. I think based on what I've seen, what I've heard, and what I've been reading about the WNI and what Marsh has been and Liberty have been sharing, I think this is a great product for something like this. It would save the day from a seller's side or from a buyer's side in some instances. So yeah, I think it's a great product, and I think it will work greatly, especially the tax parts.
Thanks, Dara. I agree with you, and I really hope that the audience start to see the value of the WNI. And just as a reminder for all our audience, you can ask all your questions. I've received one question so far. If you have any further questions, please do drop them in the chat box. Marsh, while we're talking on the topic, I'm sure you have a lot to add when it comes to the transaction structure requirement in the region dynamics. When it comes to structuring requirement of WNI policy, can you please give us some insight from a buyer and seller point of view? And if you don't mind, I'm going to give you 2.5 minutes to answer that question.
Okay, thanks, Omar. I'll try to make this quick, but this is for
I'm really sorry.
Everybody. Yeah, but everybody who's participating today, I think this is very important to understand, because this region with respect to how WNI needs to be used is very unique. And I say unique is because every country that this jurisdiction or this region represents has its own challenges with respect to regulatory issues, with respect to insurance related issues on how the policy actually needs to be produced. And when I say produced, means how it needs to be issued on paper. And just to understand that quickly, you need to look at how the process is for structuring a WNI. So at the start, when you begin to access markets, and pretty much most of these markets who underwrite WNI for this part of the world are based out of London. It's a week-long process where you approach the markets with basic information like an SPA, who are the advisors advising the buyers and the sellers, broad numbers, etc., on the basis of which you get non-binding indications from the markets. Subsequently, us or someone else will work with the ultimate client, the procurer of this insurance, to basically progress and sort of freeze up on the insurance company that they want to use. Once that is done, you then have anywhere between 2 to 3 weeks of an underwriting process that is basically involving an independent counsel that the insurance companies will engage. They will engage through Q's and A's with the procurer of the insurance, which could be a buyer or a seller, their advisors, get comfortable on the amount of due diligence and the strength of the due diligence that have been undertaken by the procurer of insurance on that transaction, etc. So basically, this is from start to finish a 3 or 4 week process in general, right? Now, where the complexity comes in for this part of the world is that as soon as you start looking at certain parameters like who is the insured, the domicile of the insured, right? So if the domicile of the insured tends to be an onshore insured for this part of the world, so a UAE onshore entity or a KSA onshore entity or an Egyptian onshore entity, you start then having an involvement with regulators, right? For example, if you have a KSA onshore entity as the buyer into a transaction, they will require to be the beneficiary of this insurance. So they will be the insured under the policy. However, the insurance regulations in Saudi and for pretty much most countries in this part of the world will not allow, or there will be issues with respect to insurance companies and their licensing to have a policy issued directly to an onshore insured into a particular country. So what that means is that you then have to engage a local insurance company to front the policy. So for example, Sally and her team might underwrite, the entire transaction, have a policy ready to incept, right? However, purely because it's an onshore insured, as well as there are insurance regulations which will come into the picture, we will have to engage with a local insurance company in Saudi. They will have to go to SAMA to get the policy approved. And only once the SAMA approval comes in is when you can actually issue the policy, right? So there comes in the complexity where it adds to cost. It adds to a timing risk with respect to how the transaction will prolong or close or when is a big question mark. Now, obviously, to mitigate this, There are nuances and structures which are possible, where you effectively try to work alongside the insurance companies, people like us, etc., and which is very importantly the reason why you bring, you start looking at W&I early on into the process, so that there is an advice which can come in through us, through your councils, etc., as to how you can change or tweak your SPAs to probably create an SP which is an offshore SPV, or to have an entity which a number of entities, private equity funds, corporates have, which is not an onshore entity, to ensure that these flow of insurance is very smooth. So Sally easily, for example, can issue a policy on an SPV which is being used for an acquisition based in Netherlands, for example, or Cayman, for example. So the process becomes a lot more smoother. You exclude then the challenges which the regulations in a particular jurisdiction might throw up, right? Again, certain nuances like having a SPA which is governed by English law and not by an onshore law or a local law in a particular country helps smoothen up the procuring of the insurance to a significant extent, right? So these are certain nuances, and pretty much a version where you need to think about how these structuring nuances needs to be inbuilt on your transaction right at the start or as early on into the process, right? Although insurance companies, us, legal counsels in this part of the world, they know how this needs to be done. And it's only, as I said, the early on you start the process of understanding how the transaction needs to be structured for ensuring the W&I can be used, the best it is.
Thanks, Nirav. Zahid, if it's okay, within a minute or less, can you just elaborate? I'm sure you'd have something to say commenting on Nirav's statement. Can you do so in a minute or less?
Yeah, sure. I think Saudi, as I mentioned, was one of the first places we went in. That same asset we sold about 5 years later to PIF, a PIF subsidiary. So during that time, we used insurance on the way in and way out for that asset. In both scenarios, it was very difficult to actually go with what the regulator wanted or follow exactly what the regulator wanted. So we had to come up with a different structure for this insurance. So we used the offshore structure Nirav referred to. It works. And I think the way we look at it is most of our transactions are transaction documents are English law governed or some other law governed, not necessarily local law in any event. So when it comes to insurance, as long as the insurer, we can reach the insurer in London or somewhere else, it's almost irrelevant. It's a process thing that Nirav, as he said, it can be managed. There's enough warning given, enough advanced work. It can be managed. From an enforceability perspective, you are not going to enforce anything in Saudi, right? The insurer is based outside of Saudi, for example, outside of Egypt. So as long as that arrangement you have and the policy is valid, from our perspective, we've never really had any concerns about enforceability. It's more putting it in place in a manner that works from a logistics and process perspective. That's the initial hurdle. After that, it's fine. So I think structuring, I would say, is not the block or roadblock to this at all.
Thanks, Zahid and Nirav. Mohammed, if you can jump in on the picture here when we talk about W&I, from your point of view as a private practitioner in the Middle East and maybe more focused in Egypt, do you have any useful comments for us for you to share with us today on this particular topic?
I don't know if they're useful or not, but I think basically what I see as a challenge in Egypt is the issue of English law. Unlike a lot of the transactions, for example, happening in the UAE, many of the M&A activity happening in Egypt do and apply Egyptian law all the way. And applying English law sometimes is a challenge. I think that would be one of the areas that might be causing some complexities in implementation on the ground, because Egypt has a very complex and long-standing judicial system, and a lot of the interpretations around enforceability issues and so forth need to be very carefully looked at. And I think it's also very important. I think a lot of investors do not succeed, or the reason a lot of investors or the investors who did not succeed have concerns about Egypt and other jurisdictions is not understanding the dynamics of the culture and not understanding the dynamics of the regulatory system. If you fail to understand these and you do not implement an action plan where you have someone from the local expertise, whether financial, legal, or otherwise, holding your hand into the dynamics of the jurisdiction, you might not have a very pleasant experience. And the whole identity of that comes in things even related to cultural background. So I'll give you an example, which is Egypt now is migrating and has been migrating to a cashless environment after post-2016. So after the reform program and the economic reform program, part of it is migrating from that. But that doesn't mean, and I was saying a lot of the businesses are family-owned, that the mindset and the cultural mindset is a cashless mindset. So when you come to a seller and tell him, okay, why don't you take an insurance as opposed to giving warranties and representation under this transaction? Some cultural background on that will be, well, if it happens, I'll deal with it then. So selling that is a point that you need to be very careful in doing it and understanding the dynamics and the background of the culture while dealing with all the regulatory and legal issues.
Thanks, Mohammed. And would you like, if we, while I'm still with you, would you like to maybe give us also more insight on the W&I practice in Egypt? Would you think this something would actually be on the rise for Egypt, or not particularly so?
Well, the first time I encountered W&I, I was very resistant to it because, you know, that was a private equity house that got busted later on. That was on the other side.
Very similar to what Zahid has been mentioning earlier. So yeah.
I was negotiating this with a private equity house that now is no longer existing, but they were just simply using that option as to pass on the risks to an entity that they had just bought 18 months ago. So I think the genuineness of the buyers and sellers in the negotiation is very important, because if you have a buyer who feels that the seller is just trying to throw him at the risk somewhere without enough guarantees, and they're trying to not take the liability because this is not just a customary practice that the PA house is adopting on every transaction and it's done in a scientific way, but it's just excusing myself from the liability and passing it on to an insurer that I have a good relation with and I have built it up. And then if something happens, you'll have to find your way to deal with the insurer, which the assumption will be that they have all these very nitty-gritty qualifications that you'll have to battle about. So there is a lot of cultural and awareness activity that needs to happen while selling the product. And I think the mindset around that is very important. But I think maybe at the end, we can touch upon some of the legal topics that might be very challenging, like, you know, why do we basically use and would resort to W&I? It's because the core to the breakup of a M&A deal is the representation and warranties. That's why you use retention accounts, escrow accounts to have a deferred consideration. So if you can avoid that by this product, that would be a golden solution. But how you do that and how you communicate it and convince both the buyers and sellers that this is a reliable product and it is going to in fact work, and it's not an experience like the one that Zahid had in 2003, because you're presenting this to a market that is not accustomed to it. That's where the difference, you can make a difference in presenting it.
Thanks, Mohammed. I am personally delighted that I'm not going to sell this policy to anyone. I'm going to leave this to Nirav and Stanley to do it. But I've seen the figures as well, so maybe we are in the wrong investment, Mohammed. But anyway, that's all very interesting. And to both Marsh and Liberty, I'm really happy to hear both three of our panelists, Dua as a client, Mohammed, leading lawyer, and Zahir as a private equity individual, really supporting the WNI, which is all great. But I think me personally and the audience as well would like to know more about claims. All right, it's all great. We want to sign this policy, fine. Then if things go wrong, can you tell us more about claims? How does it work? I think if I can start with Stanley, if you can lead on that question as an underwriter.
Yeah, sure. Yeah, absolutely. And as you say, this is, you know, the main purpose of this product is to pay out a claim if there is one. So keeping it relatively brief, but I'd say the kind of the key points on best practice if a claim arises or you think a claim arises. So the first would be to involve the broker as soon as possible. Most brokers have in-house specialists who are able to deal with claims, and they can bring a vast amount of experience and guidance to the process, and will make sure you're doing everything at the right time. So, you know, as soon as you become aware or suspect there may be kind of a fact or circumstance that might give rise to a breach of warranty, get the broker involved. I think the second point is then review the SPA to make sure that there is a breach of warranty claim that you would be seeking to bring. And on a similar line, also review the policy to check, you know, the kind of fundamentals. Is there an exclusion that doesn't cover that? Is there a limit of liability that applies? So those kind of getting that underway as soon as possible can save you time and money further down the line. I think as well as involving the broker as soon as possible, it's really key to notify the insurer as well. So one thing that you'll find is there will be a certain amount of time that's passed between the deal and the claim arising. And what that means is there's a bit of an information gap between what you as a policyholder know about the business and what the insurer now knows about the business. So bringing them up to speed as soon as possible is really helpful for the process and to keep things moving, and also keeping them updated of any kind of updates, conversations that's been had with the sellers or the business. So those are the key points. And then I think what's crucial and will really kind of help with any claims process is the claims notification. And this comes back to kind of closing that knowledge gap. So a few key points of things to include in that notification, some basic details about the transaction, obviously giving full details of the actual breach and why you think it's a breach of a specific warranty, and also flagging the specific warranties that you think have been breached. It's always helpful to be as specific as possible with that, rather than kind of a very broad brush approach and just kind of applying it to every warranty. The more specific you can be, the better. Again, also including any key supporting documents. So the thing that we find is often the cause of any delays in claims processes is information flow. So as much as you can preempt that, anything that you think will be useful in supporting, whether that's email traffic, contracts, providing all of that to the insurer straight away allows them to get up to speed as quickly as possible. I think then the final thing is valuing the claim as far as you're able to do so. Come up with a valuation of what you think the claim is worth, and also importantly providing the basis for that. So how you've reached that valuation, if there's been a multiple applied, having the kind of the model behind that and being willing to share that, all of that really kind of helps the insurer understand what the claim is, the amounts being claimed, and can then take it forward for the next steps. So really, I guess, in summary, best practice is be on the front foot, notify quickly, and just share as much information as possible.
Yeah, thanks, Eddie. It's actually quite standard. What I'm hearing seems quite standard to what we've seen in other insurance policies in terms of what you need to do in a claim. And Nirav, I'd love to hear your views on that, but I promise you, I'm going to defer this question because I've received loads of questions, particularly aiming at you. So you'll get your piece. But I would like to ask Zahid, considering the region and what we discussed today, Zahid, the waking up of the region to WNI and other structured solution, ultimately, would you really recommend warranty and indemnity to your counsels, your advisors, your clients? And
Yeah,
also hear your views about the region generally. What can we do to attract private capital into the Middle East?
Sure. Yeah. I think I understand the concerns Mohammed has highlighted in terms of sort of governing law, etc. I think those can be managed as well, by the way. We have done transactions that are not on English law and they were still covered, because it's not really about enforceability of the warranty in a specific country. It's the insurance policy you have somewhere else. But I think just on whether I would advise, I mean, one thing I've seen, I'm sure you have lots of advisors on this call as well. The more prepared, more familiar, more knowledgeable advisors are, the more likelihood that these products will be used to very good effect. I've been in meetings where the counterparty client is thanking our lawyers for recommending something like this. And their lawyers don't have a clue. They didn't even think about it. They didn't understand it. But because of the way it unlocks deals sometimes, and yes, there's displacement of liability, but in many cases, it's liability that a private equity investor wouldn't take on in the first place. So you're looking for a solution for that. But yeah, and the other thing I would say is that this is not a substitute to due diligence. As I mentioned earlier, we package this along with vendor due diligence, and we expect our counterparty buyers to undertake top-up due diligence as well. And we've sold to sophisticated investors, and they would not be, just like I was talking about in 2003, if this was still a worthless product, I don't think people would be going for it as much. So I think there's definitely, I would just say, get as familiar as possible before you kind of offer it to clients or suggest it to anybody else. And if it's a new thing for Egypt, then definitely the regulatory work in advance in anticipation of a transaction or anticipation of you having these conversations with your clients will be worthwhile. And I'm sure Liberty and Sally and Nirav will be available beyond this call to sort of engage with the relevant firms to get you up to speed. And then I think in terms of attracting more capital to the region, I mean, there's a lot of dry powder. People are looking to place money. The issue we have is that from a returns perspective, people can get similar returns in jurisdictions that are perceived to be much safer, right? We speak to a lot of the international PE guys. We partnered up with them on regional deals. The reason they would come to the region isn't necessarily to get a better return, by the way. That used to be the thinking. That's what we thought. But it's just purely diversification, purely allocation, purely to show to because a lot of money leaves this region. A lot of these guys come here to raise money. And then their LPs say, how come you never invest in our region? You only take from here. So it could be all of these things. It could be to show to the Crown Prince of Saudi that they care about the region. So the motivations isn't just the returns. As a result, one of the biggest issues you have is because returns isn't the main motivator, even for the financial investors, we're all motivated by returns. The main motivator would be these sort of additional agendas, but at no time do they want to take any compliance, ESG, governance risks. So I think this is where if we want to attract more capital to the region, we've had incidents, right? You know about the private equity scandals. You know about the London listed regional healthcare NMCs of the world. None of these have helped us. So we've got to sort of unfortunately swim against the current again. Things were looking up, but we went back and now we have to build ourselves back again. So I think good governance, focus on ESG, compliance, the advisory community being very strong on this stuff as well can give a lot of confidence to outside capital. More work between sort of firms like yourselves, Amar, with the international law firms to start engaging with sort of international capital. This kind of session, but more focused on, what is Egypt, what is the region, all of this will help, but governments have to do their part. The reforms are great, but I think a lot of responsibility rests on the private sector as well. And of course, one of the key things is to show good exits. So even if you get one investor into a country and you can show a good exit for them in 3 years' time, 5 years' time, that does open up the floodgates to a great extent. because people want to see that full cycle. And we have a case study for that. We invested in a bank in Brunei. Nobody invested from there other than for infrastructure, but because we had, alhamdulillah, a great exit, now there are a couple of other government-linked institutions that are being looked at by international financial investors, because we can show the full cycle. And the other one is strong and successful local investors. What really gives confidence to people is to see that there are strong local private equity or other financial investors within Egypt, within UAE, that international capital can look at and say, these guys are making money, so we can, and also potential partners. They're also potential partners. And when you have strong, successful local investors, they can also sell assets that they've been holding and preparing for IPOs, etc., putting in good governance. So GEMS Education is an example where we held it for about 4.5 years and we sold to CVC. They inherited a company that already had all the right governance, everything in place, from a family business to ready to list entity. They came in and took just before our IPO. We were ready to press the button on the IPO. So I would say focus from the private sector side is really important, as well as the government reforms, of course.
Thanks, Zahid. Mohammed, before I turn to you for conclusion, I think Zahid has mentioned something interesting on the due diligence. He said, the WNI is no replacement for a due diligence process. Sally, you've done this before. You're a corporate lawyer, and now you're underwriter. Tell us more about that. In brief, please.
Yes, I'll be very brief then. I think it's important to flag, and I think it addresses a lot of the concerns that have been raised today. And I guess, in short, the best way to get the most out of your policy is to carry out really good due diligence. The basic premise of a policy being that we will cover any matter subject to a few limitations that have been diligenced. So the best way to maximize the coverage that you're going to get and to make it something worthwhile paying for is to do really good diligence into all the areas that you're asking for warranties on. So each topic that a warranty addresses, we'd expect to see diligence in that area. And if that's there, then we can look to cover it. So I think that's something that potentially in the region, some advisors are now getting kind of up to speed on, but that is the best way to maximize your coverage, is to diligence and really kind of kick the tires on all aspects of the business that you want warranty protection on. And that will mean that we as insurers are able to get comfortable on those areas.
Yeah, makes sense. Thanks a lot, Sally. Thanks a lot. Mohammed, to conclude, after all of this, I mean, I'd like to hear advice to clients in the Middle East as they're preparing themselves to undertake transactions. To start with. Also, I would like to hear your advice to your audience in relation to pursuing WNI in general in the Middle East. Can you please give us a closing statement so then I can start addressing the audience questions? And everyone, apology, we're running a little bit over time, but I think there are some interesting questions that I've been receiving, so I'm going to be sharing in a minute. But before I hear Muhammad's answers first.
Well, I couldn't agree more with what Zahid was saying. I think you really need to work on educating the customer base of the product quite well. And the people who will do that is not just the insurance provider, but the advisors. The advisors need to be really carefully understanding the concept, presenting it well to their clients, and covering the differences between using it and using the old typical fashion way of just giving the representations and warranties by the buyer and using retention account. Because this product offers a golden solution for all the transactions that are happening. And I also agree with the concept that now, like you see in Egypt, all the regional banks have opened up in Egypt. You have major players like EFG, Hermes, who have been growing and developing in Egypt for many years. All this gives confidence to investors when they're doing investment in Egypt more than the government reforms. The government reforms are targeted to have these investors lead the market into giving security in terms of the flow and influx of investment and its exit and so forth. And I think the reform policies on that have given some guarantees in terms of the exits and repatriation and all that to give support to investors on these concepts. But back to WNI, I think the key concept that Sally was highlighting on the due diligence is something that is very important, that this is not a replacement to due diligence, because due diligence could result in exiting the deal. And I have a classical example of that in one of the transactions. We were dealing with a major bank, and that was a transaction in the UAE. And they asked us, okay, we have finalized everything with this deal, and we really want you to just do a sanity check for us that before we transfer the shares. So if you can spend a couple of days giving us a sanity check that we're concluding the deal, here's the SPA, and here are the corporate documents. So we looked at the corporate documents and we picked out that the company has been established 16 months ago, and that the shares are fully owned by the founders, and the founders cannot dispose their shares. So the transaction as a whole is not, you cannot physically function and perform the transaction. There is a block to implement the transaction by a full, proper, registered transfer of shares. You can do nominee solutions, but the transaction that they were about to sign off and transfer the funds for cannot happen. So the due diligence in some instances could reveal a blockage for implementing a transaction. In some instances, especially with the growth of startups and all the activity happening around that. So due diligence is a must, regardless of the options you use to cover up for the representations and warranties. This product, I think, could be a game changer for the market. I know of investors who are doing investments offshore and doing structures offshore, not in Egypt, that relate to assets in Egypt, and that would give a facilitation to implementing these type of products, because it's all happening offshore. And I see it as something that would support the expected forecast for growth of M&A activity in Egypt and in the region for the next few years.
Many thanks, Mohammed. And I think I have to say, having someone like Mohammed Khodeir in your legal team, whether you're in a buyer side or a seller side, has a lot of advantages. Not only he had this enormous experience in the Middle East and the UAE, Qatar, Bahrain, and Egypt, he also worked as a public servant for the General Authority for Investment in Egypt. And running the due diligence remotely from here, from Egypt, I think would have an enormous value in terms of the cost for clients spending on the legal fees, but still having the quality and the experience of someone of level Mohammed Khodeir's level. Thanks all for this. I have some questions. I'm going to start with addressing my first question to Nirav, as I promised Nirav. The question says, can Marsh let us know whether there are any geographic in Africa where it would be hard to find cover? That's the first element. The second element is, or is the risk focused more on the nature of the seller and the buyer itself, despite the location of the transaction? And finally, what is the typical process in terms of the involvement in the due diligence? I think we covered that, but if you can maybe give us some insight on the questions.
Yeah, thanks, Amar. I think this question came in from Karim. So very short answer, I don't think there is a geography exclusion to any region, right? So it wouldn't be that, and the whole of the insurance market wouldn't touch, say, for example, a transaction in Uganda or a transaction in South Africa or a transaction wherever in sort of broader Africa. So there isn't a thing that, somebody will just come in and say, okay, anything in Africa, we're not going to touch it. What it boils down to really is, what is the underlying transaction? There could be sector-specific exclusions at times. Like, for example, again, Sally, do jump in if you want to, but maybe Liberty might just come back and say, okay, anything in mining, we don't want to touch, right? But doesn't mean that there wouldn't be another insurance company who might be able to do a mining transaction. Whereas another insurance company might just say, okay, anything in, in the construction space, we don't want to touch. So there could be sector-specific exclusions, but not a geography-specific exclusions, just point blank. I think it boils down really to, as I said, what is the due diligence being done around on the underlying transaction? So if there is strength on the kind of due diligence that is being done on the reps and warranties that are provided under the SPA, there is definitely merit that we would find alternative insurance companies or a certain number of insurance companies interested in underwriting the transaction. Buyers and the sellers, or is there more focus on that? I think that is more to the fact where I mentioned about where is the domicile of the buyers or the buyer of the insurance per se, right? So if the domicile that at times is onshore, it could be challenging to what I mentioned. There are then the structuring nuances which will start coming into the picture. But again, it's more to do with where the domicile of the insured is, be it the buyer or the seller. I don't know on the process, if your question means on really what the process is to structure a WNI, which I've touched upon earlier. But if it's to do with our involvement on the process, then it's start to finish. So at the time when you just have a basic SPA right till the event that, God forbid, there is a claim, as Marsh, we are there to handhold the entire process, right? So again, the process from a structuring perspective for the whole of Middle East and Africa on a very generic standardized basis is anywhere between 3 to 4 weeks. It could stretch depending on the nuances already touched upon.
Thanks, Nirad. And I assume you do this due diligence alongside, shoulder to shoulder with your external counsel for whether the buyer or the seller side, right? I would imagine
so all of the DDs will have to be done by professional external third-party firms. So a financial DD could be done by a Big Four, a legal DD by one of the international law firms or law firms in a particular jurisdiction like Egypt. So Khodeir, for example, can do the legal DDs, etc. But I think where the actual DD from our insurance standpoint comes in is where, somebody like a Liberty would subsequently engage a third-party counsel for themselves to do like a $30,000 confirmatory diligence on a non-reliance basis on whatever already has been done. Sally, if you probably want to comment on this.
Yeah, I think it's a helpful point for me to add. So what we run in the background is we will engage counsel, and we'll engage counsel who are specialists in the jurisdictions that the target operates in. And what that allows us to do is, for example, if we're not familiar with some of the kind of pinch points of that jurisdiction, we can seek kind of specialist counsel advice, and that makes sure that we're kind of remaining commercial and focusing on the issues that matter. For example, something that is of relevance in the UK may just not be an issue in an Egyptian market, for example. So we will always engage our counsel as well, and they will advise us and make sure that we're focusing on the right points and kind of guide us through perhaps some of the more trickier jurisdictions and keep us focusing on the kind of pertinent issues in that region. And that applies for tax as well. So I know tax was talked about, and that's really important for us. Obviously, it's one of the more difficult topics to underwrite, and we make sure that we are kind of coming at it from an informed basis and a kind of a locally informed basis as well, because we appreciate that we at Liberty are not necessarily going to have all the knowledge at the kind of touch of a button. So we'll get specialist advice on that to make sure it's relevant.
Obviously, you can't use the same counsel acting for the seller or the buyer for this, obviously.
That's right, yeah. So we'll clear conflicts as soon as we're instructed, and make sure that the law firms, we have a panel or a range of law firms that we can go to make sure if there is a conflict for whatever reason, we've got other options.
Good. While I still have you here, Sally, I have a question from David Avasti. They would like to speak more about premium charged and what are the factors which determine the level of the charge.
Yeah, sorry. So yeah, there's a lot of factors that go into every kind of pricing of a deal, and it also varies depending on market condition, which is slightly unhelpful as an answer, but I guess they can range from anything from perhaps 1.8, 1.9% of the limit that you're taking will be the premium, up to 3, 4, 5%. And the kind of the factors that we will base that on will be the sector. So if it's a really difficult sector, or one that kind of typically gives rise to more issues, perhaps pharmaceuticals, for example, the rate's going to be higher. Another factor will be the jurisdictions and the spread of jurisdictions. So if it's in one kind of UAE or a kind of a Dubai-based business, then perhaps that's slightly easier to underwrite than something that has multiple jurisdictions all over the region. So that will feed into the rate that we would apply and the premium that's charged. And then you have kind of deal specific factors. So when we're quoting, we try and get as much information as possible from the information memorandum, a management presentation, any information that we can be provided with, we will use to kind of feed into how we see the risk of the deal. So, you know, it may be that a founder-owned business is perhaps slightly more difficult to underwrite and more risky than one that's had institutional investors owning it for the past 5 years, for the reasons that we've talked about this morning, and the kind of the corporate governance, for example, that an institutional investor will feed into a business. So there's a lot of factors. Every deal is different. The market and how competitive it is at that point will also affect the rate online. If it's a really great business, for example, an infrastructure deal, which W&I policies and insurers like, and there's lots of competition, that will naturally kind of keep the rate and the premium down, versus one that's a lot more tricky and perhaps there's fewer markets, whether that's for the various reasons we've talked about, that will push the rate up.
Thanks, Sally. I would have assumed that also one of the factors would be the value of the deal itself, isn't it?
That feeds into it. It feeds into it, and obviously the higher the deal, usually the higher the limit that you're looking for, and therefore a percentage of a bigger number makes a bigger premium. But we try and look at deals on a fact kind of basis rather than a size. And yes, a much larger deal presents different issues, but actually a smaller deal can be more difficult to underwrite if it's a smaller business owned by founders versus a large private equity sale. So it's probably not one of the kind of material factors that affects the price, but it does feed into it.
That's very interesting. I was delighted to hear that, because like us lawyers, we don't particularly, or me personally, I don't tie my fees in terms of how much my client is defending or pursuing. Ultimately, my fees is a representation of the time and expertise that they're spending, despite how much the value is, which I think makes perfect sense to me. I have a question from Tony Rav. It's an anonymous question. What number, frequency, and value of claims have you been seeing for W&I policies that have been written to date?
Okay, so obviously I can speak from a regional perspective, right? So obviously the claims are always a function of the number of policies that have been placed in the region as compared to the more sophisticated Europes and the Americas and the Japans of the world is still way behind in terms of the number of policies that actually have got placed and do sort of see the placement as on today as well.
Can you name these countries again, Nirav? Japan, you said Japan?
No, so Japan, Australia, Europe, Americas, they pretty much use W&I as a pretty regular thing. I think if not every transaction, but every 2 or 3 transactions in these jurisdictions would typically tend to see a W&I being explored and potentially used as well. So obviously, when the usage is so high in these jurisdictions, there are most definitely a number of claims. Like our teams in these geographies probably have seen more claims from I think 1 in 8 policies, the statistics that I had last go, that every 1 in 8 policies sees a claim. So pretty much like a 25% sort of a number would have a claim on it. In the region, honestly, except for 2 notifications that I've seen in the last 6 odd years that I've been doing W&I in the region, I haven't seen really a claim payout actually happening. So even these notifications haven't really turned up into a claim as yet. I don't know about the last one that I know. It's a very recent notification, but we haven't really seen a claim payout actually happening for this part of the world. But again, that doesn't mean that the product doesn't work, because claims payout happen pretty regularly in other jurisdictions.
Thanks, Nirav. And I really appreciate that we are 20 minutes past our scheduled time, but I'm I'm actually happy to see that we haven't lost much of an audience. People are still engaging with us. We have more than almost 50 attendees. So it's actually, people are keen to listen to the answers. So while we do this, I think I have the last question from Maya Shar. She's saying, many thanks to the panelists. It's a very informative discussions. Thanks, Maya. She would like to know, could you please expand a bit more on the challenges which may be faced between jurisdictions and examples of how these can be overcome? I think that's a good question. I think it's again for Marsh and Liberty to advise on, but Muhammad and Zahed, Dua, if you'd like to comment, please jump in. If I may start with Sally, if you'd like to respond to mine.
Yeah, and I think again this comes down to DD, and so no deal is the same as the last one, and most issues that come up on a deal can be dealt with through good diligence, a good Q&A process between both us and the insured, and the sellers. So I mean, I think obviously each jurisdiction does have specific areas that are perhaps more contentious or more likely to give rise to claims in that jurisdiction. From my perspective as an underwriter, that just means I'll focus on that area in underwriting, and kind of perhaps ask a few more questions on that to try and get comfortable with that area. I guess, and then I think the other point is more of the transaction structural points that we've discussed on the call. And again, so for example, a KSA insured can be difficult, and we have to put a structure in place. But we've done a deal that bound in May with a Saudi buyer, so there's lots of possibilities there. So from my perspective, there'll be DD issues that vary for every deal, all of which we'll use our counsel to help guide us through those. And we really rely on the underwriting call, which is part of the process that will take place for us to kind of to speak to the buyer and get their view on it, and get their advisor's view on the issue. That's for us one of the kind of main sources of comfort that we can get on a deal, is hearing the purchaser speak to these issues, knowing that they understand them, knowing that they've looked into them, and with all of that fed in with the information in the data room, the Q&A that's being asked, we can usually kind of get through any obstacles that are jurisdictional and kind of specific to that jurisdiction. I'm not sure if that answers the question, or if there's another element that perhaps wants to be addressed.
Maybe Nirav can jump into it, and of course, Maya, if you have any follow-up questions, please do ask them. Nirav, would you like to elaborate?
Yeah, I think I'll probably just add one important aspect to this, which obviously I've referenced it earlier, but the earlier you start into the process of looking at a WNI on a particular transaction, a lot of these challenges can potentially be have a mitigation against, or probably, we might be in a position to tell you that, okay, we've seen similar transactions in the past where, say environmental issues are a problem. You might not get insurance around it, or a certain representation, the way it's worded currently on your SPA, it's not going to be something that the insurance companies are going to be comfortable to sort of insure against, the way it's just the way it is. So what that allows is that, you can work with your counsels to tweak the language in way the reps and warranties are being sort of negotiated, structured, so that potentially when you go back and when the diligence is being done around those reps and warranties, you probably are going to be in a better position to have a coverage around those as compared to how it was, at the start of it. And then obviously, those nuances around the offshore, onshore are sort of the real challenges for this part of the world. So using sort of, structures like indemnity structures, novation of deeds, or novation of the SPAs back to the onshore entities, there are various means and structuring or restructuring possible that could help navigate and ensure that a WNI can still be procured.
Many thanks, Nirav. Muhammad and Zahid, any last comments on Nirav's and Sally's answers to the questions before we conclude?
Yeah, I think this is going mainstream now. This is no longer a private equity product. So I think whatever these challenges are, as we progress, you'll see more and more solutions and more precedents. The first time is always difficult in any jurisdiction or any circumstance. The people who use it the second time make it a much easier ride. And we've been there as first-time users in some instances. Second time has just been so much easier. So I think I wouldn't worry too much about the challenges, because that's what the advisors on this call, their job is to figure it out. I would focus on on figuring out when you might actually use this. And as I said, get to know the product, get to know the instances where this could be useful, and discussions with the client. Clients don't know about this yet in newer markets. In established markets, they do, as I've mentioned, in Asia and parts of US, Europe, very familiar now. So I think that education Mohammed referred to earlier, education of the clients, but even before that, I'd say the advisors educating themselves and spotting. That's what we do as lawyers, I guess, right? We don't necessarily know all the answers, but we know the questions, and we know where to look, and we know where things are relevant. As long as you figure that stuff out, the rest of it is actually, from what we've seen, it's painful sometimes, but it gets done many times. We're in the middle of one right now, infrastructure related, and there were some challenges, but as far as I know, Nirav has the latest, but I think we're there. So I think it's very feasible, and it is mainstream now. It is about to become mainstream in other countries as well.
Thanks, Zahid. Mohammed, I know you're very patriarchy in your approach, and it's one of the principle you had in mind when established KP. Any closing statement from you when it comes to educating clients about W&I? Any recommendations from you before we wrap up the session?
No, again, I agree with Zahid. I think all this education and activity needs a bit of holding hands by the advisors, working with the sophisticated private equity houses and investment banks that are working in Egypt and are aware of this type of product. But also, I think the conclusion from this webinar is really that this is a golden opportunity for the expected M&A activity in Egypt. If drawn upon properly with all these educational activity and coordination with the leaders of transactions in Egypt, I think there is a golden opportunity to make use of that in M&A activity and potentially in capital markets, which we can have another event for soon.
Many thanks, Mohammed. Stanley Hearst, Nirav Moody, Zahid Kamel, Mohammed Khodeir, and Dua Kamdil, thank you so much for your time. Thank you so much for our 60+ attendees that showed up today. I hope you guys found it interesting. I personally will be reaching out to you and share this webinar has been recorded. So I'll be reaching out to you individually and share the webinar to you, so then you can share it internally and use it. Until I do that, I hope everyone to enjoy the rest of the day and have a productive day. Thanks everyone.
Thank you.